Well, a former FDIC chair suggests market optimism over lower rates is premature. She warns inflation is still a significant issue. Sheila Bair is known for running the FDIC during the financial crisis, and the hot topic of inflation making it into her children's Money Tales series. Her newest book, Princess Persephone and the Money Wizards, coming out this fall. That sounds like a page turner, Sheila. I'll get one for my kids. Let's talk about this in terms of premature, because the implication of saying that the turn in rates is premature implies that this run in banks is premature as well.
Well, look, I think that the focus still needs to be on inflation, and I think the Fed needed to strike a much more hawkish tone, if only to offset the irrational exuberance of the markets trying to, create expectations that are significantly loosening financial conditions at this point. So inflation's not, the Fed itself says that they're not going to hit target until 2026. Services, you've still got some pretty robust price increases. Housing's coming down a bit, rents at least, but not as much as we were hoping. So, yeah, there's a long way to go on this fight. And I do worry they're blinking a bit and now starting to pivot and worry about recession when I don't see any of that risk in the data so far. That was a classic, problem that Arthur Burns made. He was premature in lowering rates again because he was worried about recession. So I do think this is a mistake. I think they need to, keep their eye on the ball, the inflation ball, and tame the market, not reinforce it with this very dovish dot plot.
Ms. Bair, big fan of your comments over the years. When you look at where we are right now in the environment, if what's not being discussed is QT. So QT is going to be there until probably at least middle of next year, which still has some tightening characteristics to it. And no one could agree upon how much tightening it is, whether it's 25 basis points or 50 basis points. That's happening in the background. Is that enough tightening in the background to alleviate your concerns where the Fed might be, quote unquote, taking their eye off the ball?
I don't advocate. I don't think they should raise rates again. I think they should stay put. We've got good trend lines. We need to be patient and watch and see how this plays out. And you're absolutely right. There is still some tightening going on with the roll-off of their incremental roll-off of their portfolio. And of course, real rates go up too. If inflation goes down and the Fed fund rates stay where it is, then your real rates are also going up. So yes, there is some tightening going on, even if they don't raise rates. But my concern is the prospect of significant lowering of rates in 2024. They need to continue to tighten a bit. Inflation has not been beaten. There's still some significant warning signs. We've got other dynamics, this huge deficit spending, relentless demand for debt issuance by the Treasury. We've got, trade restrictions. We've got an aging population. We've got a lot of things going on. They're going to create potentially more supply constraints. So I don't see this battle anywhere close to being done. And yeah, I do think it's premature to send this kind of signal right now.
Hi, it's Karen. I was going to call you Sheila, but then he called you Ms. Bair, and so now I really don't know what to do. But let me just ask you the question, which is Basel III, so new regs, something you know a ton about. Yeah. And there is just a huge amount of pushback. How do you think it shakes out at the end?
So I think it's a very big package of rule changes that really aren't responsive to what's going on now. These were responsive to unfinished business during the great financial crisis, primarily around operational risk and market risk. I think the regulators, there's some good things in that package, some things that give me some concern. It's very complex. I think it'd be good if they broke it up and focused on the operational and market risk pieces of that. The credit risk changes, there are some improvements, but they don't really raise additional capital. This idea that Basel III is going to hit lending, credit risk charges, capital charges actually go down a bit. But the market risk in particular, for the very large, complex banking organizations, do a lot of trading, a lot of derivatives, a lot of international operations, organizationally complex. The risk-based capital rules really have never addressed that business model, and I think that's where they should focus in the near term. But break it off in pieces. It's just too big to do at once. And the public doesn't understand it. The political support's not there. I think they need to regroup and try to do this in stages.
Sheila, last quick question. I believe the last time you were on the show, I asked you if you owned any bank stocks.
I do not own any bank stocks. I do not. And I still do not. No, I don't. Yeah, no, I don't. Well, I'm in index funds, but I'm sure have a lot of bank stocks in them. No, I don't. And that's not that I'm averse to it. I think well-managed banks that pay a regular dividend are fine stock holding. But I do a lot of this kind of commentary and so I decided a while back not to have any bank stocks.